Debt. The word Gen X was taught to fear, the thing their parents warned about, the trap that destroys households, ruins relationships, and follows people to their graves. But here's what the most financially successful Gen X people quietly understood. The right debt, used at the right moment, structured the right way, didn't just survive retirement, it funded it. Not despite the borrowing, because of it. Today, we're going through 5 ways strategic debt built Gen X wealth, and why the ones who borrowed anyway, despite the fear, ended up ahead of those who didn't. Like, subscribe, and let's start. Number 1. The leverage effect. Controlling $300,000 with $60,000. Here's the part of debt nobody explains in school. Borrowed money multiplies the impact of the money you actually have. A Gen X person who bought a $300 home in the late 1990s with a 20% down payment put in $60,000 of their own money. The bank provided the rest. And what happened next is the core of why strategic debt builds wealth. Over 25 years, that $300,000 home, appreciating at a conservative 2.8% annually, became worth approximately $598,000. The gain was $298,000. But here's the key number. That $298,000 gain came from an initial investment of $60,000. Return on actual cash invested? Nearly 500%. Without leverage, without the mortgage, without the bank's money, that same $60,000 invested in a diversified market portfolio at 7% annual return would have grown to approximately $325,000, a gain of $265,000. Significant, respectable, but smaller. The mortgage didn't just buy a house, it amplified the return on every dollar of personal capital. That's leverage. Borrowed money working on your behalf. The bank funded the majority of an appreciating asset. Gen X made the payments, and at 65, they owned something worth nearly $600,000, having put in $60,000 of their own money 3 decades earlier. The fear was the debt. The reality was a 500% return. But the leverage effect is only the beginning. Because inflation, the same force that drives up the cost of living, was also quietly doing something else to the debt itself. Number 2. The inflation gift. Why fixed debt gets cheaper every year. Here's something inflation does that nobody mentions when they're complaining about it. It erodes the real value of fixed debt. A $200,000 mortgage borrowed in the year 2000 at a fixed interest rate was a real commitment of $200,000 in the purchasing power of that moment. In the years since, cumulative inflation across developed English-speaking countries has ranged from approximately 75% to 90%, meaning the purchasing power of money has roughly halved or more over that period. Which means the remaining balance on that mortgage, in real terms, measured in $2,000, is worth significantly less than the number on the statement. The debt shrunk, without a single extra payment, without refinancing, without any action at all. Inflation simply did what it always does, reduced the purchasing power of money, and in doing so, reduced the real burden of every fixed debt alongside it. Meanwhile, the asset bought with that debt, the house, the investment property, the business equipment, typically inflated with the general price level. Its nominal value went up while the real value of the debt went down. Gen X borrowed in money that was worth more. They repaid in money that was worth less. The bank lent in stronger dollars. They received weaker ones back. The borrower quietly captured the difference across decades. This is why long-term fixed-rate debt held against appreciating assets is one of the most reliable wealth mechanisms available, and why the generation that borrowed for productive assets in the 1990s and early 2000s arrived at retirement with inflation working quietly in their favor. And if leverage and inflation weren't enough, there was a third force working in favor of strategic borrowers, one that most people never fully accounted for. Number 3. The tax advantage, when the government helps pay for your investment. In most developed countries, interest paid on debt used to acquire income-producing assets is deductible from taxable income. Investment property financing, business loans, borrowing to acquire assets that generate rental income or business returns. The government, in effect, shares the cost of that borrowing, reducing the real interest rate paid by the borrower's marginal tax rate. Here's what that looks like in practice. A Gen X investor who borrowed $300,000 to purchase a rental property at a 5% interest rate generates approximately $15,000 in interest in the first year of the loan. In most English-speaking countries, including the United States, Australia, the United Kingdom for investment properties, and Canada, that interest is deductible against the rental income the property generates. For a borrower in a 28% income tax bracket, that deductibility creates a tax saving of approximately $4,200 per year. The effective real interest rate on a 5% loan becomes 3.6%. Over the first decade of the loan, when interest payments are at their highest, that tax benefit compounds into tens of thousands of dollars in reduced real borrowing cost. The government helped pay for the investment, not through a grant or a subsidy program, through the tax treatment of interest on income-producing debt, a benefit embedded in the structure of productive borrowing that significantly reduces its real cost below the stated rate. Gen X who used debt to acquire income-generating assets borrowed at 5% while effectively paying 3.6%. Those who avoided debt entirely paid full price for everything and left a meaningful tax advantage permanently unclaimed. The principle is consistent across most English-speaking countries. Interest on debt that produces income is treated more favorably than almost any other financial cost. The question was never whether to borrow, it was whether to borrow productively. But leverage, inflation, and tax advantages all require one thing to work. The return on the asset must exceed the cost of the debt. And some Gen X people understood this equation better than others. Number 4. The return spread, borrowing at 6 to earn at 12. Here's the arithmetic behind investment leverage. If money can be borrowed at 6% and deployed into an asset returning 12% annually, the spread, 6% on every dollar borrowed, creates wealth that didn't exist before the loan was taken. $100,000 borrowed at 6%. Annual debt cost, $6,000. Invested in a business, a rental property, or a productive asset returning 12% annually, $12,000 per year. Net annual gain above the cost of debt, $6,000. Over 10 years, $60,000 in wealth created from money that wasn't personally owned. The borrower used the bank's capital to generate returns that exceeded the cost of that capital. The spread between the borrowing rate and the return rate is pure wealth creation, achieved without requiring the full capital to be personally available. This is how businesses build, how property portfolios expand, how wealth compounds faster than saving alone would ever allow. The risk is real. If the investment returns less than the borrowing cost, the spread works in reverse. If the asset loses value, the debt remains. Leverage amplifies outcomes in both directions. But Gen X who borrowed at 6% to invest in assets returning above that rate, property, business, diversified markets over long periods, used debt the way the financially sophisticated have always used it, as a tool that accelerates what would otherwise take decades. And even without any of this, without leverage, inflation benefits, tax advantages, or return spreads, strategic debt was doing one more thing for Gen X, something quieter, something that turns out to be one of the most powerful wealth mechanisms of all. Number 5. The forced savings mechanism, the payment that built equity. Here's the one that surprises people most. For Gen X who bought homes with mortgages, the monthly payment wasn't just a cost. It was a forced savings deposit. Every mortgage payment, every month, automatically, without requiring discipline or decision, split into two parts. Interest to the lender, principal reducing the balance. And that principal reduction represented real equity accumulating in a real asset. The equivalent Gen X person who rented, paying the same or similar amount monthly, made zero equity deposits. The payment went entirely to the landlord. Zero accumulation, zero ownership. Over 25 years at $1,600 per month, total paid $480,000. The renter, $480,000 spent, zero equity remaining. The homeowner, $480,000 paid, a property worth approximately $598,000. Fully owned, no mortgage remaining. Same monthly outgoing, completely different outcome. The mortgage created a mechanism that compelled wealth accumulation even when discipline wavered, even when markets were uncertain, even when the news made everything feel dangerous. The payment went out, the equity came in, month after month, for 25 years. Psychologists call this pre-commitment, structuring a decision in advance so that good behavior happens automatically, rather than requiring repeated willpower. The mortgage was the most effective pre-commitment device Gen X ever signed. The debt that built retirement. Here's what strategic debt actually produced for Gen X. House equity after 25 years, approximately $598,000. Tax advantages on investment property interest invested over 2 decades, approximately $80,000. Return spread from investment leverage over 10 years, approximately $60,000. Combined, nearly $740,000 in wealth built, significantly through borrowed money. Not all debt, not consumer debt, not credit card balances or car loans for depreciating vehicles. Productive debt, fixed rate, long-term, against appreciating assets. The distinction matters completely. Gen X grew up being told that debt was the enemy. That lesson was real. It was valid for its context, but it was incomplete. Because the same mechanism that destroys financial lives when applied to consumer spending, a car, a holiday, a sofa on credit, creates extraordinary wealth when applied to productive assets over long time horizons. Debt on things that lose value is destruction. Debt on things that gain value is construction. The mortgage that felt like a burden every month for 25 years produced a $598,000 asset. The business loan that felt risky in year 1 produced $60,000 in net profit by year 10. The fixed-rate borrowing that felt expensive at 5% became effectively 3.6% after tax benefits, and then became even cheaper in real terms as inflation eroded its value year after year. Gen X, who understood this distinction, arrived at 65 with something the debt avoiders didn't: the compounded result of leverage working for decades on their behalf. The fear was the word. The reality was the wealth. Give me your thoughts in the comments. I'll see you in the next video.